The topic for our discussion is time value of money. But before we proceed with the discussion, I would like to draw your kind attention towards the fact that time value of money happens to be one of the most important topics to be discussed in finance. And time value of money lays a foundation stone upon which all the successive discussions shall be built upon. So it is very imperative for us to understand this topic clearly, and to facilitate an easy learning, I have incorporated certain handwritten slides to derive some formula. I have tried to take you through the derivation part, and I've tried to make them as simple as possible for you to grasp, so that you can appreciate the actual application, you can appreciate the concept with the help of which you can be in a better position to understand not only this particular topic but also the successive topics which we shall be discussing later on. Now the question arises, a very pertinent question arises, that what exactly do we mean by the word time value of money? What is the meaning of the word time value of money? What do we actually mean when we say that there is a value attributed to money with the passage of time? In very layman's term, the time value of money says that money has got a time value. It means that it is the time factor which lends certain value to money. The cornerstone or the hallmark of the time value of money concept says that the money at our disposal at the current time period is of utmost importance to us. Whatever money we are having, whatever money the investors are having with them right now is of utmost importance, rather than what they shall be having in the future, whether it is a mid-term future, whether it is a long-term future. Now, why is it so that the money at our disposal right now is considered to be more valuable than the same money which we shall be receiving in future, suppose 2 years, 3 years, 5 years, 10 years down the line? It doesn't test our intelligence much when we say that when we are having our money right now, we can use that money into multiple number of uses. That money can be consumed, that money can be spent, that money can be invested in order to generate some future returns, that money can be speculated. In other words, there are a lot of benefits which are associated with the money which we are having with us right now. Rather, when we are parting away from that particular money, it means that we are foregoing all the benefits which I have enumerated right now. We shall be seeing it in our successive discussions. Now, one more pertinent point is that money at our disposal right now is considered less risky than the money which we are not having right now. The money which we are having at our disposal right now is considered to be less risky than the money which we shall be having in the future. Less risky, why? Because, as I've just said, there are a number of benefits which we can enjoy if we are having the money right now. And most importantly, the money with us at this particular time period at present is free from the risks of default, which is one of the most glaring risks which is concerned with the money. Second area of discussion which we shall be having in our mind right now is that the concept of time value of money is extensively used across all the important financial management decisions. In our previous discussion, while we were talking about the introduction to financial management, we saw there are a number of activities associated with a firm, with an economic entity. All the activities, namely production, distribution, marketing, sales, after sales, HR, legal, finance, IT, almost all the key functional areas are interlinked with each other with the help of the finance functions. So, in a nutshell, we once again revisit the point that if there is an inadequate access to the source of finance, then all the functional areas of management will not be in a position to work seamlessly, or the day-to-day operations shall be seriously impeded, which shall not be in the best interest of anyone, of any of the stakeholders. Then we saw that the entire structure of financial management rests heavily upon three pillars which are known as your finance functions, in which the first was your financing decisions, the second was your investment decisions, and the third was our liquidity or dividend decisions. A quick recap: financing decisions refer to all those decisions which are concerned with the raising of sources by exploiting the various sources of finance against the most minimum cost of capital. Secondly, when the entire finance which has been raised from all the sources are being invested across a various class of assets, whether they're the long term, medium term, or short term, that is termed as the investment decisions. Last but not the least, once the decision has been made into investment of the assets, various classes of assets, it is equally important that the returns are being generated from the assets and the returns are being distributed amongst the stakeholders in the form of either dividends or interest or repayment of capital, or even to provide for the working capital management. One thing, student, time value of money enables a comparison between two different set of the cash flows which are being segregated with time differentials. Once again, time value of money enables a comparison between two set of cash flows which are segregated due to time differences. Now the question arises that why exactly this segregation taking place? Why is it so that cash flows are being divided or they are being segregated between each other due to time differences? Why it is happening, we shall be discussing it shortly, but prior to that, let me talk about one benefit of time value of money. Time value of money enables a comparison between the two sets of cash flows which have been segregated with time difference. I once again repeat, students, the time value of, this is one of the most important points. The time value of money helps in making a comparison between two cash flows which have been segregated due to the time differences. So they are trying to, in some way or the other, the time value of money enables a comparison between two sets of cash flows which are different from each other, which have been set apart due to the time differences. Now again, coming back to the point that why exactly the question of a time difference coming? Where exactly it is coming from? Why exactly we are having a time difference? A close look into the basic accounting equation, that is a C plus L is equal to A, which we discussed in our last discussion, you will appreciate a point that in almost all the decisions you will find that the cash flows are entering the firm at T0 or at the current time. I once again repeat, almost in all the decisions you will find that cash flows are entering into the firm. There is an inflow of cash flow at the current time period or the T0. The T0 refers to the present time. The T0 refers to the current time frame wherein the firm is operating. It is the time which we are in which we are living right now. It is neither the past, it is not the future, rather it is the present time. So I am denoting them with the term T0. Like most important financing decisions related to capital budgeting, raising of funds through equity, shares and debentures and borrowings, payment of interest and dividend involve the concept of time value of money extensively. So you will find that your first decision, that is your financing decision. When we start with the financing decision, as we said, we all know that financing decisions are those decisions we are concerned with exploiting the various sources of finance wherefrom the money can be raised. The long-term capital, the medium-term, the short-term capital can be raised. So whenever the firm is exploring various sources of finance, and from those sources of finance the money is being raised, that particular money is entering into the firm at the present time frame or the T0. It means if the firm is raising the money in the year 2017, in the year 2017 itself, the money shall be flowing into the firm. Secondly, when the raised money, we all know that the money which has been raised or the finance which has been raised by exploiting the various sources of finance, they are not meant to be kept idle. They are never meant to be kept idle in the firm. They need to be invested. Again, when the investment decisions are being taken up by the financial manager, wherein he or she chooses to invest the raised funds across various classes of assets, that investment results in an outflow of cash. That particular investment results in an outflow of cash, And very interestingly, that outflow itself takes place in the T0 or at present. Suppose the finance manager decides to make an investment into a long-term machinery, into a long-term asset against which he has to commit $100 million. So that particular amount has to be committed right now in T0. Now, from here on, an interesting point arises. When we are raising the money at T0 or at present, and we are deploying the funds or money in across the various classes of assets right now or T0, the cash flows arising from such decisions, they are not immediate. Now listen to me very carefully. I once again reiterate my point. Let me make myself even more clear. When the firm is exploring the financing decision and when the firm is exploring the investment decision, under both the decisions, the cash flows are taking place at present or at T0, whether it is a cash inflow via the financing decisions or cash outflow via the capital budgeting decisions. Both the inflow and the outflow are taking place at present or at T0. They are not taking place at any distant future. But the resultant cash flows, I once again repeat, the resultant cash flows which take place or which shall be taking place due to these two decisions, those cash flows will not take place at T0, rather they shall be taking place at future, sometimes in the future, which we are denoting by the term Tn. So whatever cash flows, whether inflow and outflow are taking place at present or at T0 via the financing decision as well as the investment decisions, the resultant cash flows from such decisions will not be taking place at T0, rather they shall be taking place sometime in the future, which we are denoting by Tn. So this is one crucial point which explains that why exactly a time difference is taking place. Now, to understand it simply, let's start with the financing decision. As I have already mentioned, that suppose the firm is exploring the various sources of finance wherefrom she is raising the finance. So the moment the firm is issuing equity shares, the firm is issuing debentures, the firm is going for a bank loan, the firm is issuing preference shares, against those financial securities, the investors or the bankers, they are providing the firm with the money which is entering into the balance sheet at T0 or at present. But cash outflows pertaining to the payment of dividend, the payment of interest, or simply put, the payment of the returns on such cash inflows or such financing help do not take place at immediate future. Suppose the equity, we all know that equity shares are the longest source of finance. They are the permanent capital, they are the perpetual capital for the firm. Debentures, they are a source of a long-term financing, 10 years, 15 years, 20 years down the line. Long-term bank loans, again 10 years, 15 years. So it means that against the financial securities like equity shares, debentures, bank guarantees, cash inflows are entering the balance sheet or they are entering into the company at T0 at present, but the return which has to be repaid in the terms of interest and dividends on such cash inflows have to be paid not now but in the future. So a distinct cash differential is taking place. There is a mismatch between the two cash flows. Cash inflow is taking place at right now at T0, while the cash outflow is taking place in the distant future. Secondly, when the firm is contemplating an investment decision, when the firm is making the investments into the long-term assets, into the capital assets, at that time too, the cash outflow is taking place at T0. When the firm is purchasing a machinery, when the firm is investing into a long-term machinery, due to the investment process, the cash outflows are taking place right now. The cash outflows are taking place at T0. Why cash outflow? Because against the machinery purchase, the amount has to be paid, and that amount is leaving the balance sheet of the company. And that exodus of the cash, that movement of the cash, or outward movement of the cash, is taking place at T0. But again, I mentioned the point that it is an investment. When it is an investment, the capital assets are bound to, they are expected to ensure a return against the investment which has been made into them. So whatever investments are being made into the assets, whether they are the long-term asset, they are the short-term asset, they are the liquid asset, they are the medium-term asset, a distinct return is always expected out of them. Again, such returns are not immediate. It is not that at T0, when the funds are being deployed into the assets, at the same year the revenues starts pouring in. It never happens. So especially if it is a case of a long-term asset, if it is a case of a capital asset, capital assets have, technically speaking, they have a life of more than 5, 6 or 10 years. So it has got a longer gestation period. So the cash inflows arising out of the fund or out of the invested assets, they are not immediate, but they are distant. So the cash inflows against such a cash outflow will not take place in T0, but rather they shall be taking place into the future or into the Tn. Thus we see that under both the decisions, again a time difference is taking place. A time difference is bound to take place. It might seem a bit confusing, but the fact is that it is with the help of the time value of money that such comparison can be made, because it is never possible for the firm to sit idle and not take any decisions just for the sake that since there is a time difference, no decisions can be taken. So a time difference is not an excuse for not taking any decisions, because of course when we are carrying out a business, when you're carrying out an entity, business entities are always taken up with an going concern basis. They are always meant for a long time operation. So when we are dealing with a long term operation, when you're looking into the future, conditions will take place wherein a time difference is bound to take place. So at this juncture, time value of money plays a very important role. It acts as a very important tool in the hand of the finance managers, with the help of which they can narrow the gap, or they can bridge the gap, or simply put, they can make the cash flows comparable. They can make two distinct cash flows, two different cash flows, different in terms of the segregation due to the time factor. Such cash flows are becoming more and more comparable with the help of the time value of money. Now again, coming back to the original point, that why is it so that the current money is so important? Simply put, we have already discussed, when we are parting away with our current cash, when we are parting away from the cash which we are having at T0, then all the temporary benefits, or all the benefits which we just discussed, they are being lost temporarily. So when they are being lost temporarily, it means that when the benefits regarding the consumption of cash, the transaction of cash, the investment of cash, the speculation of cash, when such benefits are lost temporarily due to parting away from the cash, then in that case the investors always require for a compensation against which they want to part with the money. So far we are talking from the corporate finance point of view, from a firm's point of view, wherein we are discussing the importance of time value of money in the light of time differentials cropping up from our three important decisions, that is the financing decision, investment decision, as well as the liquidity decisions. From here on, we are talking more on from an individual's point of view, that why is time value of money so very important for him or her as well. So it is not that time value of money is important only for the corporations, rather they are important for the day-to-day life of common people as well. A quick recap: when investors are having funds with them, when their investors are having money at their disposal at present, it means that they are in a position to enjoy a list of benefits, a host of benefits in terms of current consumption, speculation, spending, investment, etc., etc. But when they are parting away from their current cash, it means all these benefits are being lost temporarily. Now, when such benefits are being lost temporarily, when they have to be given up temporarily, then the astute investor, an astute investor will always look for a compensation, or he will look for a reward for parting away from his benefits, although temporary. Once again, although these benefits are lost temporarily, an astute investor will always look for a compensation, or for a return, or for a reward for parting away from such benefits if he or she has to part away from his money, if he or she has to invest his money for a time frame which is different from his current time frame. Obviously, when you're talking about different time frame, it means what? He has to move into the future from the present. So it means that when an investor is being asked to part away from his money for some time period in the future, he or she, and if he or she is, he should be astute enough to ask for a return which shall compensate for all the benefits which he or she is losing or he or she is foregoing for parting away from his money. Because if he or she was having the money along with him right now, then they were in a position to either transact, speculate, invest, consume, etc., etc. But when they are moving away from their money, when they are parting away from their money, it means for the time being they are being deprived of these benefits. But these deprivations should be made good. It should be compensated by way of a return. In fact, such return is known as an interest. Such an interest is known as the interest, or such a compensation is technically known as a required rate of return. The required rate of return, it means it is the rate of return which is required by the investors for parting away from his or her current benefits. Now, required rate of returns broadly comprises of two vital concepts. So from here on, the discussion becomes a bit comprehensive. So let's pay some attention to this. The required rate of return broadly comprises of two vital concepts. The first of these two concepts of the required rate of return is the risk-free rate of return. Now students, a quick recap. When we just started our discussion regarding time value of money, we saw that there is an element of riskiness which is associated with the money which we are having right now. So it means that when the money we are having at our disposal right now, it is comparatively less risky as compared to the money against which we are parting right now. So the thing is that when you're talking about the required rate of return, or we're talking about the compensation which the investor shall be requiring for parting away from the money, such compensation shall be comparing of two parts. First one being the risk-free rate of return, and second is the risk premium. So how do we define the word risk-free rate of return? What is the meaning of the word risk-free rate of return? So simply put, the risk-free rate of return refers to the rate of return which the investor shall be earning without taking any risk, without taking any mental stress, without unnecessarily taking any risk. Any return which investor is earning, that is known as the risk-free rate of return. A classic example for a risk-free rate of return is a bank fixed deposit for a time frame of 3, 4 or 5 years, against which the bank is giving the investor a guarantee of paying a I% rate of return, rate of interest for the time frame for which the bank FD is being locked up with the bank. So the bank is under a liability. The bank is giving a kind of a guarantee to the investor that whatever deposits has been made in the fixed deposit with the bank, that is safe in the hands of the bank, and that particular principal amount shall be fetching a return thereupon for a stipulated time frame. So such a return is a classic example of a risk-free rate of return, because in order to earn that particular interest, the investor is almost taking a zero risk or a nil risk, because the entire liability is resting upon the head of the banker. He is giving a guarantee for the return, repayment of the principal as well as the interest thereupon. The second example are the government securities. Second examples are the gilt-edged securities which are being issued by the government treasuries, against which or behind which there is a sound government backing, because we all know that governments have got an specific or a privileged right, it has got a privileged benefit, it has got a privileged advantage of printing the notes even in the case of the default. So in a very simple case, risk-free rate of returns are, technically speaking, they are those rate of returns against which the risk of a default is almost negligible. The risk of default is almost nil in the case of the risk-free rate of the return. Second is the risk premium. The second component happens to be the risk premium. So before we go into that, let's try to understand that when an investor is willing to part away from his or her cash right now for a investment into the future, the return which he or she shall be requiring shall comprise of two parts. First is the risk-free rate of return which he or she would have been earned without taking any risk regarding default or the repayment of the principal and capital, and the second part shall comprise of the risk, and for the second part shall comprise of the risk premium, which shall be trying to cover all the risks. It should be trying to compensate against all the risks against which the investor is exposed into. So in the successive slide, students, we shall be looking at a certain number of the risks against which the investor is exposed, which is different from the risk-free rate which we are talking about, and there is a host of the other risks against which a higher risk premium need to be demanded by the investors. A simple rule of the thumb says that higher the risk premium, higher shall be the required rate of return, or higher shall be the compensation which will be required to take care of that particular extra risk which investor is taking by parting away from his money. So that's all for now, students. In the successive slides, we shall be talking more on the risk premium and the way they need to be tackled by the investors. Thank you.